Welcome to The Explainer. Today, we're diving into how one company, Lemonade, is using AI to take on a true giant, and I mean one of the biggest industries on the planet. To kick things off, let me ask you a question to really frame this.
All right, think about this for a second. What's an industry that's bigger than AI and cloud computing put together? Seriously, take a guess. It's probably not what you're thinking.
The answer? Insurance. Yep, the insurance industry. It's kind of wild when you think about it. We, as a planet, spend more on insurance than on defense or oil and gas or even the entire software industry. We're talking about a multi-trillion-dollar prize, and that's exactly what Lemonade has its eyes on.
Okay, so you've got this massive ancient industry, right? But here's the thing. It's also a giant with clay feet. It's surprisingly vulnerable. The old guard, the big names we all know, they're really struggling to keep up. Let's dig into why that is. The CEO of Lemonade has this perfect analogy for it. He says the old-school insurance companies are carrying a heavy backpack. Think about it. All the things that used to be their biggest assets, like tens of thousands of agents, are now, in the age of apps, weighing them down. They're stuck with these ancient computer systems that just suck up time and money, and their whole culture is built to resist change, not embrace it.
And that's where Lemonade's whole thesis comes in. They're saying, look, you can't just patch up an old system with a little bit of new tech. No, you have to start from scratch. Build the entire thing with AI at its very core. That's the only way you can actually delight consumers, price risk better, and just slash costs across the board.
Now, a great idea is one thing, right? Making it work is the hard part. And for a long time, a lot of people were skeptical. They were like, can this model actually work? Well, let me tell you, the numbers from just the past 2 years, they don't just tell a story, they shout it from the rooftops. It's been a dramatic turnaround.
Okay, before we jump into the juicy numbers, let's quickly define a term that was a huge deal for them: liquidity risk. It sounds complicated, but it's not. It's just the risk that you'll run out of cash before your business really takes off.
And the second thing you have to understand is the loss ratio. This is like the single most important number in insurance. All it is the percentage of premiums they have to pay out in claims. You want that number to be as low as possible. Simple as that.
All right, check this out. Just 2 years ago, Lemonade was literally burning $63 million in a single quarter. That liquidity risk we just mentioned, yeah, it was a 5-alarm fire. But now, fast forward to the last quarter, and they generated $48 million in cash. That is an insane reversal. It's a complete flip from a cash-burning machine to a cash-generating one.
So, the other big knock against them was, okay, they're a tech company, but do they actually get insurance? 2 years ago, their loss ratio was a pretty scary 94%. That's not good. But today, it's down to 73%. A 21-point drop is just massive in this industry. It's proof positive that, yes, they have cracked the code on how to price risk.
So, how did they pull this off? How did they achieve this incredible turnaround? Well, it all comes down to this really clever growth model they call the angle raise. Let's take a look at what that actually means.
So, if you look at this chart, you see two lines. The top one, revenue, is shooting up, almost 50% growth in just 2 years. But now look at the bottom line. Their operating costs, it's flat. It's actually gone down a little. That widening gap between the two, that V-shape, that's the angle raise in action.
Remember that heavy backpack we talked about? This is how they dealt with it. The plan wasn't to shrink their costs or take stuff out of the backpack. The plan was to grow into it. As their revenue just explodes, those fixed costs become a tinier and tinier fraction of the business. The backpack doesn't get lighter. The company just gets way stronger.
And this is the payoff. They've already hit cash flow positive, a full year ahead of what they predicted. This isn't just a theory anymore. It lays out this super clear, super believable roadmap to full-on profitability. The model is absolutely working.
Okay, so they've de-risked the business model. The growth engine is humming. So what's next? Well, now they're aiming their AI-powered cannon at the biggest target of them all, the absolutely massive car insurance market.
So why cars? It comes down to one thing: price. Their own data shows that if you can drop your price by just 10%, you can literally double the number of people who sign up. In this business, price isn't just a big deal. Price is everything.
But that leads to the obvious question, right? How in the world can a relatively small company like Lemonade hope to compete on price against a $50 billion Goliath like Geico? It sounds like a total mismatch. It sounds impossible.
Well, the answer is data. The old guys, they price you based on these really broad, blurry proxies. Things like your credit score, your marital status, your age. The CEO calls it a 2D cardboard cutout of you. It's not really you. Lemonade, on the other hand, uses telematics, that's the tech in your phone, to see how you actually drive. Do you brake hard? Do you text and drive? They build what he calls a 4K picture of you as a driver. So your price is based on you, not on some stereotype.
So you put it all together, and Lemonade has what you could call 3 unfair advantages. First, the telematics data gives them precision pricing. Second, they have a way more efficient, low-cost way to get customers. And third, that AI automation we talked about keeps their own operating costs radically lower. For an incumbent to try and copy this, they'd have to tear down their entire business and start over. It's a structural advantage.
And that leaves us with this final, really powerful idea. Lemonade is making a huge bet here. They're betting that AI isn't just a fresh coat of paint for an old industry. They're betting it's a way to tear the whole thing down to the studs and rebuild it from the ground up. And look, if they're right about that, then this angle raise we've been talking about, that's just the very, very beginning.